All right, good. Thanks everybody for joining. This is sponsored by our law firm SMB Law Group, How to Negotiate Investor Terms Like a Pro. Kevin and I started out 2 months ago, 3 months ago now, can't remember when it was, to try to create a resource on SMB or small and medium-sized business, lower middle market, premium main street investor terms. Since interest rates rose, what was now 2+ years ago, the need to understand the market and raise capital for your small business acquisition has exploded. And nearly every transaction that we work on, or I'd say probably, what percentage would you say, Kevin? 60/40, a
That's probably about right. Maybe even a little higher, honestly.
little higher, has some sort of capital raise or investor component to it. Smart folks, good folks are going out, finding high quality small businesses, and they're going, I don't have the money to acquire this business because it requires, if you're using SBA financing, 10% SBA equity injection, and you may not have that money, or you just want to de-risk. You want to put more equity into the deal. You want to have a little bit of diversification of risk. Maybe don't want to put all of your nest egg into it, or you just are looking to financially engineer some smart acquisitions. They're raising capital. However, much like most things on Main Street, the ecosystem or the marketplace for investor terms was very Wild West and still is, but there's becoming some more market practices or market norms in the space. We thought, let's put together a resource for the space for folks like you guys, I suspect, that are interested in buying or investing in small businesses that cover what we typically see. I admit a few more people into the room here that cover what we typically see. Now, the baseline is, and Kevin had some color here, but there is no standard market for really investor terms at this level beyond what we're going to share with you guys today. And we see all kinds of different things. We see pure common investment. We see really aggressive venture capital, traditional search fund style, independent sponsor style investments. We see a variety of things. The archetype of transaction that these investor terms are geared toward is your what would you say, Kevin, $12 million enterprise value transaction?
That's right. Yeah, I think that's a good range.
Those deals more often than not are going to be SBA backed, which allows for high leverage. And they're going to be businesses that typically do somewhere between 750K, maybe a little bit lower, some instances, 500K to $2 million in earnings, whether that be SD or EBITDA. So that's largely what we're talking about today. We're talking about U.S. investing as well. I don't know if there may be some international folks on the call, but most of this pertains to U.S. based lower middle market acquisitions. Anything else to say, Kevin, before we go to the next slide?
No, I think that's a great intro, Eric. I think let's just jump right in and get people. I'm going to actually drop, I think, as I start to say something else, saying no, there's nothing else. I'm going to go ahead and drop, for those that don't have it, into the chat a link to download. It doesn't necessarily accompany the presentation, but we published about a month ago a guide or what to expect when raising capital and things like that. So I'm going to drop that link in the chat window right now for those that haven't found it yet or don't have a copy, so you can download that as well to supplement what we're talking about here today. But other than that, I think let's get moving.
Yeah, and if at any time you guys want to jump in, turn your cameras on and ask any questions, feel free to interrupt us, ask questions. I'm sure there are other people who are thinking the same thought that you're thinking, so feel free to share it with us. We're fine. There's about 72 people in the room right now, so a meaningful crowd, but certainly not too big for you to jump in if you've got something you want to share. We will do Q&A at the end as well, so feel free to hold it till then as well. Kevin, do you have the ability to advance the slide here?
Sure do.
Okay, give me the disclaimers.
Yeah, I was going to say, do you want me to do the boring legal part? Obligatory disclaimers, guys. We're making this available really as educational content. It's informational in nature. Obviously, everyone's circumstances, the terms of your raise, what you're doing with your business, personal circumstances, they all vary. So nothing that we're saying here is actual legal advice or investment advice, financial advice, tax advice, etc. This is intended to be a primer, a good educational overview, and arm you with the information that you need to then go out and work with your own service providers and advisors in making the right decisions. We are, just to hit, and we can go over a little more towards the end about our practice generally and things like that, but you can see here the the breadth of where we currently practice with licensed attorneys within the firm. And then, of course, we really do practice nationwide. So this is targeted across the spectrum for a couple of reasons. Number one, if there's local law issues, we partner with the right people in states where we're not licensed if needed. But number two, when it comes to equity raising, this is largely federal law driven anyway. The compliance with federal securities laws. There's some minor state law compliance and nuance we may get into later in the presentation, but by and large, this is all stuff, no matter where you're located, if it's dealing with equity raises, it's well within our wheelhouse. So with that backdrop and those disclaimers, let's jump right in.
Well, Kev, we got to update our map too, because you're now licensed in Utah, right? We still had that one shaded in light
that's
blue, so.
indeed. The light blue in Utah was a pending, and that's actually full. I was admitted about 5 weeks ago. So
our Utah friends are probably like, what are we? So anyways, just having some fun with it. Keep going.
So just jumping in, overview, and we'll get right to the meat here in a second, but this is just a high-level overview of what we intend to hit today. So we want to talk through sources and uses of capital and really understanding the inputs and outputs of your deal, because it largely drives the capital structure for your investment. And I think there are a lot of things that searchers, especially new searchers, first-time searchers, and folks that haven't raised capital before lose track of, that don't get accounted for as they're modeling their equity raise. We're going to walk through a typical capital structure and use a straw man example to carry us through that fits solidly in the self-funded search kind of size and type of deal, just to give you some raw numbers and how these things break down. We're going to talk through concepts like the equity step up and how much actual equity and dilution you're giving to investors. Different forms of equity investment. There are different forms in how equity is raised into companies, and we'll walk through those. Certain economic levers that you can pull to sweeten the deal, or sweeten the deal for you as the searcher, and try and balance on the whole what you're giving to investors versus keeping. And then finally, disclaimer, this is not the legal disclaimer. This is the disclaimers about the presentation. This is really self-funded search centric. The equity raising methodologies, the economics that we're talking through and things like that, really, there's no market. You'll see this as point two, despite claims to the contrary. There's not like a market for self-funded search equity, but there is developing norms and practices and what investors expect in the space, and just wanted to be upfront that what you're hearing here is really limited to that self-funded search ETA space. And so as you start to think about traditional search, independent sponsor, et cetera, different models that we may address in future presentations, but that's not really the crux of what we're doing here. So with that overview, Eric, should we jump in? We've got sample sources and uses here. If you maybe want to walk through the typical breakdown, or
Kev, I see numbers and my eyes glaze over, and I know this is your forte, so feel free to take number two here.
Eric is our accounting expert. No, I'm kidding. I'll keep going here then. So what you're looking at here on the screen is a typical, albeit reasonably simplified, sources and uses table that you would use to begin to model your equity raise. And I don't think the line items are particularly like what the actual issue line items in particular are the important takeaway here. I think what's important here is to understand the concept right here at the bottom of total project cost. And I think what we run into quite frequently is folks who are under LOI to purchase a business for $3.7 million that start to model their equity raise, how much equity capital they're taking from investors, what sort of dilution they're going to have, et cetera, based on $3.7 million purchase price without taking into account.
Kevin, can I interrupt you for just a sec? We've had a few people ask if this session is going to be recorded. Are we recording this?
We are recording, yes.
It is being, okay. So we will share that. Please stay on though, if you could. That's not us encouraging everybody to jump off and watch the recording. Please stay on and ask questions. But Kevin, keep going. I'm sorry I interrupted you.
Yeah, no, you're fine. So all I was saying there is, as you start to think through the initial modeling, as you have a deal under LOI and you're starting to think about raising capital, is you want to make sure that you're starting from the right point. And the starting point is your total project cost, right? You need to look at all of the uses for your transaction. It's not just cash to the seller. It's not just the seller note for the purchase price. equaling $3.7 million in our example, you've also got transaction expenses. You've also got excess cash to the balance sheet for working capital at closing. So on a $3.7 million purchase, you may have a total project cost of $4 million. And if you have started to model your deal based on a $3.7 million purchase price, in my example, you're already starting behind the curve. You're starting off with the wrong footing. It's going to have a compounding effect throughout your equity raise, your capital raising strategy, and your overall dilution on your cap table. So I think first and foremost, as we start to walk through an example, it's to make sure we're talking apples to apples here, not apples to oranges. And you really start as you're pulling together post LOI, how you're going to attack your equity raise. You start with what are all the sources, what are all the uses, and making sure that you're plugging the right holes with investor equity based on the total uses. In this example, before we move on, I'll just point out that if you didn't fully walk through all of your uses, take into account excess cash, take into account deal expenses, et cetera, and you modeled on $3.7 million, you could be in a scenario where you think you only have to raise $250,000 of capital, and all of a sudden you're undercapitalized and can't get your deal done. And so it really highlights the importance of making sure that you're starting with the right information from the get-go so that you have a successful equity raise.
Well, and Kev, tick back to that one for just a second too, because
Sure.
I think this chart could literally say, guys, 2025 on the left, 2022 on the right. We had a marketplace that when interest rates rose, valuations didn't decrease alongside. By and large, most businesses are still selling for about as much as they could, high quality businesses are selling for about as much as they could conceivably sell with SBA debt. The makeup for that is this investor equity tranche, right? So the SBA lender will say, hey, that business at this interest rate just is not going to, it's going to sell at the same price, but we can't lend as much money on it. So we'll give you 2.8. That's going to pencil out, but everything else needs to come in the form of investor equity to get it done. So this is the big shift that you saw from 2022 to 2025 is needing these larger tranches of investor equity. And by and large, many folks have stepped up to fill those holes and plug those holes on good transactions. But again, this is a good illustration of what's happened generally in the marketplace for the last few years.
Yeah, it's a great point, Eric. So let's walk through, and this is where we're going to get a little bit wonky with the math, because I want to keep going with this example, and then we'll be able to circle back based on this straw man as we talk through some of the other principles here.
And Kev, we're getting a couple questions in the chat about what type of equity allocation would an investor get for an investment this size. So this is the chart. Obviously, that's going to answer this question. This is the typical capital structure for an SMB investment. You've got a $4 million project cost out the door, top line for the deal that we just looked at a second ago. This one is modeled off of a 15% equity injection, $600,000 being 15% of the total $4 billion project cost, which again includes not just the purchase price, but your costs as well. Right. Searcher is going to be required. Now, the baseline SBA expectation is that when you buy a small business, you have to inject 10% of the purchase price. That 10% does not necessarily have to come entirely from you. That's where the investors come in. And you can reduce that to 5% with what's called a seller standby note, which is a great topic for another day, but suffice it to say, you can reduce the overall equity injection from 10% to 5%. We hear a lot about the zero down acquisition, the no money down searcher acquisition. Those are pretty rare. Those really happen for very sophisticated people who have transferable skills, people that are buying a business that they're familiar with. In most cases, the SBA lender is going to require the searcher to have some skin in the game, and that's usually in the range of 1% to 3%, with the balance being able to be made up by the equity investor. In this scenario, we're modeling off of a 15% equity injection, which sometimes folks do that much. Sometimes they do more. Sometimes they do the 5% minimum. But here we're modeling off of a 15% equity injection, which is $600K. In this scenario, we've got the searcher bringing 10% of that, or $60,000, and we've got the investors bringing the $540,000 balance. And then the SBA loan is going to make up the 85% delta, which means the searcher in this instance is only bringing 1.5% of the total project cost. The investors are bringing about 13.5% of the project cost. This is a pretty good hypothetical for what we see in a lot of transactions. We see a lot of $3 to $6 million deals. where the searcher is going to bring somewhere between $50 and $100,000 down, and investors will bring the balance. And then we'll show you in just a second on the next chart what that results in actual equity allocation. You want any color to add, Kevin, before we move on?
No, yeah, I guess the only thing to point out, and just one correction, so it's not the SBA loan that makes up the 85%. In this example, it would be SBA loan and seller note,
The seller note,
right? So
that's
you have some subordinated financing through the seller, but suffice it to say, this is a highly levered acquisition, right? 85% of the total project cost here is in debt on the go forward company, 15% in equity based on cash. And so you've got this, I only circle back to highlight the 85-15 because it becomes important as we start to move through and start to talk about some of the economic levers and things like step up. So with that, let's move over to the step up and talk about this. So one of the questions that we get routinely, obviously, is, okay, so when investor capital is coming in, what does that mean for the overall dilution and ownership of the company? There are two schools of thought, and what happens in the self-funded search community is effectively a balance between the two. One school of thought is the private equity independent sponsor model, which is the investors are putting in the cash, therefore they get 100% of the business until they get a return of capital, and then the searcher that put the deal together gets some share of profit, right? That's your traditional private equity type of structure. The other school of thought is the overall deal value is $4 million. Investors have put in 600,000 if you include the searcher capital, which is 15%. Therefore, the investor should own 15% of the company. But that swings the pendulum the other way, right? And in the first example, the investors get the lion's share of the economics for putting in cash. In the second example, the searcher gets the lion's share of the economics with putting in very little cash. If you flip back, they're only exposed, you as the searcher, assuming many of you listening are people looking to buy businesses, you're only exposed 1.5% cash position on this business, but in that example would be owning 85% plus of the economics. So that's where the concept of the equity step up comes in. And this is where we look at the capital structure and say, okay, all of the economics going to the investors doesn't make any sense, but also limiting the investors strictly to their percentage share of the overall enterprise value doesn't make sense because they're the ones putting their cash on the line in the way that the searcher, the sponsor, isn't. That has to be balanced with the fact that the searcher is signing the personal guarantee. So it's not that the searcher is maybe putting cash on the line, but they are actually putting a significant amount of their wealth, potentially, depending on what their assets and things are, on the line for this acquisition. So the way that we generally see these deals work out in the self-funded search or ETA community is this concept of a quote unquote step up. Those of you who are private equity professionals, just to spend your understanding of what step up means in a private equity concept. What we're talking about here in step up is what sort of multiple on the overall project value are investors getting based on their money? And so all the equity step up says is that you apply some multiple to the percentage that the investor capital represents to the overall project cost. So tracing back through the math here in our example of $600,000, which is 15% of the overall enterprise value, $600,000 or 15% would be a 1x multiple, right? 600,000 divided by 4 million is 15%. If they own 15% of the company, that it's a 1x multiple. If you were to apply a 2x step up, right, investors are getting 2 times the amount of ownership in the company relative to the percentage of capital that they've contributed. On 2x, the investors are going to own 30% of the company, right? They put in 15% of the overall project cost, but multiply by 2, a 2x step up. That means they're going to own 30% rather than 15% of the economics of the company. And that multiple can adjust. It could be a 1.5x step up. In this case, that would make it whatever 15 times 150% is, that would 22.5%.
We have such a difficult example in here. In our guide, guys, we have a couple hypotheticals predicated off of $1 million EV, $1 million project cost. It really simplifies it a lot. But yeah, keep going, Jeff.
Yeah. So just to break down, and it becomes important, we're going to circle back to what happens with the searcher equity, but we broke out on purpose the external, the third party investor money to show what this means for those investors. In our example, just to back up, keep in mind that the searcher put in 60,000 and the other investors put in 540. That's your aggregate 600,000 or 15%. If we're just looking at the investors, the people that you as searchers are going and trying to raise capital from, we want to talk about this $540,000. Advancing back forward, that 540 is 13.5% of the overall project cost. So when you apply an equity step up, they're going to get some multiple above that. So a 1.5 times step up means that they're getting 20.25%. A 2 times step up, didn't mean to go forward. 2 times would be 27%. A 3 times step up would be 40.5%. And so you can see it's a pretty simple math exercise of a multiple of the ownership relative to the overall enterprise value, or project cost is the better term, for the acquisition. In terms of step ups that we actually see, Eric, I don't know anecdotally what you would say that the vast majority of our transactions that I'm usually seeing are going to be between 1.5 to 2 times step up. I think it's pretty rare to get as high as 2 times, and I'm not sure I've ever seen a deal as high as 3 times.
I've seen 3. We've got a deal right now that's being shopped at 3, and they're raising a lot. So they're trying to obviously encourage people to invest. But yeah, 1.5 to 2.5 is the typical, but I do have one at 3 right now.
Yeah.
It's a great deal. I'd take it.
And the flip side is we don't see 1x very often. There's usually some level of step up, but it does happen occasionally. I would say I see that more in kind of friends and family raise deals where it's brother or frat brother and Uncle Joe that's coming in and they just want to support the endeavor and they're comfortable with no step up. But it does happen occasionally. I just wouldn't expect really it from third-party investors.
And Kev, a really important point for folks to understand too is that most of these deals are SPA. And if you have north of 20% or north of 19% of the business, you have to personally guarantee the debt. That's the quantitative requirement. A quantitative requirement is the 19% threshold. So when you're structuring this, more often than not, you work around that. And obviously we're talking about investors in the aggregate. In some instances, we have had lenders say at 15% with a preferred return, which we'll talk about in a second. That's also too much because in the aggregate, we feel like your economics are such that prudent lending requires that we ask you to personally guarantee it. So sometimes 15% is maybe a better cutoff. Qualitatively, there are some instances where they say, even though you have less than 15% or a small amount, you're so important to the deal, we still want you to personally guarantee it. So something, if you're going to be an investor and be very heavily involved in a deal, you may still run into an issue where you make yourself feel too important to the bank and they still want you to personally guarantee, even though you're below that threshold. And then someone asked the question, is this in addition to a preferred return? And the answer is yes. We'll talk about preferred return in just a sec. This is simply your equity allocation. And then for the less intellectual, Kevin, you're so high functioning, I want to give just a simpler example for the folks that are more like me. If you've got $1 million business, 10% equity injection, if the step up is 1.5%, you're going to get 15% of the business. If it's 2.5%, you're going to get 25% of the business. So much more simple mathematical. I think in future presentations, we should probably work that into the numbers here to help ourselves.
It's a double-edged sword because on the one hand, like nobody's raising equity on $1 million acquisition. So I think there's some benefit to gaming out a typical deal, but I totally get from a math exercise. I appreciate you breaking that down, Eric.
But also somebody asked, is this common equity? And in most deals, and do we have a slide that addresses the participating preferred structure? We do.
Yeah.
Cool. Yeah, so we'll talk about that in just a second. But yeah, this is for the preferred investor class of equity, which we'll talk about in just a moment.
Yeah. So I think before we get here, and in fact, let me back it up before we go to that slide, just to set the scene there and circle back to one of the questions on the personal guarantee point. I just wanted to underscore there that the 20% threshold, or under 20% to your point, Eric, is for an individual or affiliated investor. In the vast majority of cases, in this example, where you're going out and raising 15% of the project cost, maybe on a 2 times step up, so 30% of the overall ownership of the company, that money's going to be raised from several investors, and no one of those investors is going to be at that 15, 20% threshold. So the personal guarantee threshold is generally not implicated. An example like this, if you're raising $600,000 to get a $4 million deal done, you've probably got 5, 7, 10 investors on that cap table investing anywhere from $50 to maybe $200,000 each. So they're all going to be well below that 20% threshold. So then the question becomes,
cliffhanger.
Sorry, I got asked to sign something here. So then the question becomes, okay, what is the step up? Like, how do I know what step up to give to investors? And this is where we have to be a little cute and say, I don't know. We're your lawyers that help on the legal side of things. We're not investment bankers. And this is where your modeling and your economic modeling really comes in, and how I want to transition to this next slide of what are the forms of equity, and then what are the different economic levers that we can pull. Because generally, what you do with the step up that you allocate, as well as the other economic levers you pull, is largely going to be a function of how you're modeling returns for your investors. Your investors are not making an investment decision, or if you are listening, are an investor, you generally wouldn't be making an investment decision based on the step up. You'd be making your investment decision based on modeled IRR, what sort of return profile you're targeting. And that return profile is going to be impacted by the step up and other economic levers that we're going to transition to talk about, things like preferred return. So the direct answer there, which is maybe a little bit unsatisfactory in terms of how do I know what step up I provide, that's not a direct answer we can provide, because that depends a lot on your modeling and what your investors are wanting to get out of the investment, and whether you can get the return profile thereafter with a 1.5 times step up. Awesome. If it takes a 2.25 times step up, that may be where you have to go in order to get that return profile to work out.
So Thiago Brando asked the question, is preferred equity counts towards the 100% U.S. citizen equity ownership? And the answer is yes. It's got these, and this is such a new SOP change.
Yeah.
Not really within the scope of this presentation, but preferred equity is true ownership of the business. And we'll talk about, I guess we're talking about it now, how that's structured.
Yeah, you want to pick up here, Eric, and talk
Sure.
through the preferred, common, kind of waterfall?
Yeah, for sure. And I'll just give you the base case, and then Kevin, you can add some color on the edges. But what we do in these deals, guys, is we have two classes of equity. We have a participating preferred share, not a converting share, but effectively it works the same way. We have a participating preferred share that the investors are going to invest through, and then the balance of the business ownership outside of the equity that the sponsor or the searcher gets for their actual invested dollars is going to be common equity. So two classes of equity. When you put money into the deal, your ownership is going to be held through this preferred share. That preferred share is going to have a bunch of rights and privileges that the common equity is not. Most importantly is the fact that your initial equity injection or investment piece is paid back first from distributions of the business. Now, again, the sponsor or the searcher can also take preferred equity alongside the actual investors. So for their portion of the equity injection, they're going to be alongside you and paid back first for that equity injection. It also receives a preferred return, which I think we have a slide that we'll talk about preferred returns on as well, but it'll actually receive obviously a preferred return on that initial injected capital until it's returned. And then it'll have a suite of governance rights that will protect the interest. And these are often negotiated pretty heavily. But suffice it to say, you should, as an equity investor in a deal, have a bunch of minority investor protections or some degree of minority investor protections where you can veto if the operator or buyer wants to do certain things. Sell the business, bankrupt the business, take debt beyond certain levels, give themselves raises, affiliate transactions. All the stuff that if they're going to do it is fundamental to the business or antithetical to your interests, you'll have those veto rights as a minority investor. Once your initial invested capital, so again, let's use the $1 million example, $1 million purchase price, you're putting in the full 10%. Let's say you have a 10% preferred return. And we'll talk about the market on that in just a second, but 10% preferred return on $100,000, because again, you're putting in the full 10%. Each year until it's paid down, you'll accrue $10,000 in interest on that. And then once it's paid back, you will then participate alongside the common. So your shares or your units, depending on the structure, will actually then have the same rights and privileges as the common shares that are held by the sponsor once you're paid back. Kevin, pick up there and tell me all the things I forgot.
I don't know that you forgot much. I think we have a couple of questions that are worth answering, but I think you nailed you nailed the explanation there in terms of the waterfall. I think in this context, one of the questions that came up is how would this work if you're raising though from like friends and family, right? Maybe some money, like my prior example, from like your frat brother that you've known for 25 years, or your actual brother or parents or something like that. The short answer is it could be the same, particularly if you're going to have both in your deal. You're going to have some friends and family and some third-party investors. The flip side of that, though, if it's just friends and family, and Eric, I'd be curious to hear what in your deals in practice, I would say more often than not, you don't get into any of the structure we're talking about, and everyone just goes in together, owning common, all one class. There's no sort of preference, priority returns, or anything like that. And it's, hey, if I'm doing a $3 million deal and my dad's going to put in 250K and my brother's going to put in 150K and I'm going to put in 150K, we're all just going to like pro rata that percentage based on the 1x step up. And I, as the searcher, am going to take the balance of the common due to me personally guaranteeing the loan and things like that. So if it's truly just friends and family, we see that much more as just everyone has common. There's no step up, and it's just pro rata on that 1x step up with you as the searcher taking the balance of the economics due to the personal guarantee and things like that. Another question that came up is, insofar as we're discussing what's quote unquote typical, does this preclude an S Corp structure? And I slightly tongue in cheek said the short answer is not necessarily, but probably. Raising capital with two classes of equity is precluded with an S Corp structure. That doesn't necessarily mean that you can't raise capital from outside investors and use an S corporation as long as you don't create separate classes of stock. So everyone has to be the same class of stock. But with an S corporation can be owned by any sort of institutional or entity investors. It has to be owned personally by individuals. That's usually where you're going to get hit with investors if you have the appetite to try and do an S Corp structure, because many investors in this space are investing through investment vehicles and funds and entities that they have which can't own an S Corp. So it's possible, it's conceivable that you can structure a deal that has similar characteristics to what we're talking about with one class of equity, but there are other reasons that likely make that untenable. So we generally tell clients, like, yeah, if you're raising outside capital, S Corp's probably not the way to go, unless you're back in my prior answer. It's friends and family. It's your dad and your brother coming on the cap table. They can come on in their individual capacity, and there's no separate class of preferred stock. Then an S Corp is possible.
Do you have to give all investors the same terms, Kevin?
In a standard deal like we're talking about, not necessarily. You can have as many classes of equity as you want. That said, in a deal of the size that we're talking about, that would be pretty atypical, and I suspect would be pretty difficult to sell to other investors. Why is X investor getting a sweetheart deal and I'm not? Is it just because it's a bigger check? And if so, why isn't the preferred return and the bigger economics enough to compensate for that? So I guess I would struggle to understand what would drive needing different.
We do see from time to time, if you've got, like I had one a few months ago, and there was a group of 3 people who were going to actually operate the business. They were also putting in capital, but they were going to bring some sweat equity. And so they said, we want more preferred structure in light of the fact that we're putting in sweat equity in addition to just capital. And you have to be careful with that from a tax perspective, because there are some issues around compensatory shares versus typical invested dollars and how that affects you for triggering tax now versus later. So whatever you do, make sure you talk to your investors, right? Go have a conversation with your investor. If you're talking about both sides of your mouth with 2 different groups, guess what? Eventually it's challenging to have them not figure out who's getting what in that business when they all own a slice. Most cases, you'll have a cap table that's just going to lay it out. They're gonna be asking why they're getting less than everybody else. But if you do want to do it for good purposes and everybody agrees, you still want to have that tax conversation with a CPA or a tax attorney to make sure it jives.
Yeah. The only other place that I see that somewhat routinely, though the structure's rare in the self-funded search space, is when there's rollover equity. Oftentimes the equity that the seller is rolling a portion of their purchase price into may be a second class because you're specifically negotiating a priority return to your investors that are actually writing cash checks to get the deal done. I've seen deals where the rollover seller also isn't getting the preferred return that we'll talk about here in a second. So that I see that more common than like actually raising cash from investors, and those investors are put into two different classes of buckets. It's usually going to be class A are the investors writing checks, and class B are going to be like the seller rollover equity because they're going to have a slightly different economic. Maybe they're not going to get the step up. Maybe they're going to get their return of capital behind your class A investors that are actually writing checks, et cetera. So that would be the one place where I would say maybe that's a little more common. All right, so let's jump forward and talk then about some of the other economic levers. I mentioned a minute ago in the step up discussion, okay, how do I know what step up to apply? And that's a difficult answer because it's all a function of what the return profile is for the investors. And there are other levers that you can pull in order to affect that return profile and move things up and down. The equity step up is just one of them. Like we have listed here, discussed before, the typical range that we're going to see is between 1.5 to 2.5 times step up on the equity side. But some of the other levers that you can pull are a preferred return, right? And so this is effectively an interest rate on the invested capital. And so the preferred return says that if I'm investing $100,000, you as the company are going to pay me an interest rate on that $100,000 until I get that original $100,000 that I invested back. So it's a quasi debt structure where the invested capital is almost operating like a loan, where you're incentivized due to an interest rate to try and return the investor's capital as quickly as you can reasonably do and responsibly do as the operator. We used to see a couple of years ago preferred returns in the 7 to 10% range. Obviously, we're in a different interest rate environment the last 1.5 to 2 years. I'd say much more commonly now we're seeing 8 to 12%. But again, there's not a ton of rocket science here in terms of these are things you can flex up or down based on what investors are expecting and how it affects the return profile. Right? You may be in a scenario where, given the cash flow of the business, it's more palatable to pay a slightly higher preferred return rate in order to keep your equity step up a little lower so that your overall fully diluted ownership is a little higher, or it could be vice versa. There are other levers you can pull, right? You've got a CEO salary. If you're going to buy this business and be the operator, there may be a scenario where you can tweak and play around with your own salary as the operator of the business based on your own personal circumstances and things like that lets you affect the return profile and have either a lower preferred return or maybe slightly lower equity step up. And what would that be? That would be maybe you're a 2 working spouse household and you've got a spouse that's a solid income or high income earner, so you don't necessarily need the salary here. Maybe you say, hey, I'm comfortable with a $75,000 salary, which increases the return profile to investors slightly, which means maybe I can get away with a 9% preferred return instead of a 10% preferred return and model the same type of returns that my investors are targeting. Really, the point here is your equity step up and your preferred return are probably the 2 most common economic levers that you have. But there are potentially other ones that you shouldn't necessarily discount taking a look at. That's going to be things like your salary, right? You may be in an opposite scenario where you're the sole breadwinner of your family. You really have to have a certain level of income and you want that CEO salary to ramp up pretty quickly. And that may be a trade-off the other way. Maybe you're okay accepting an 11% preferred return for investors in exchange for a $150,000 salary ramping up to $200,000 as you improve EBITDA margins just because of your personal circumstances. The point is, you've got economic levers to pull, and it's all a function of the returns to your investors as you start to build out your cap table model and zero in on what is the right equity step up, what is the right preferred return, what are the other correct economic levers for my deal to get the investors to make the deal attractive to investors. Eric, anything else I'm missing there or anything you'd correct?
No, I think it's good. We have searchers too that are progressively pushing on these salaries and packages and stuff like that. I've got somebody right now in the Bay Area, and obviously they live in the Bay Area, they have children, they need more money than if you live in Indiana.
Yeah.
All of this stuff is negotiable.
Absolutely. One of the things I'm seeing in the comments before we move on that maybe we should address are tax distributions, and are distributions made to both common and preferred equity holders? Do they count as a return of capital, et cetera? This is a little bit of a complicated answer, and there's a lot of commentary out there in the community. So I'll just tell you how I see it. Number one, yes, technically distributions would be made both to common and preferred equity holders. But remember, if it's an LLC, which is where we're talking about tax distributions, you only owe tax if you have profit allocated to you in a given year. So depending on where we are in the waterfall, it's conceivable that the common, at least in the early years, doesn't have any profit allocated to them because they're further down in the waterfall and things like that. So the profits are generally allocated so that the capital accounts that owners or members of the LLC are taxed on track the economic reality of their ownership interests, and that takes into account the waterfall. That said, how are tax distributions counted? And I think this is a really important nuance that some folks get hung up on. I would say by and large, the norm is that any distribution of any character that goes to members is counted as part of the waterfall. And investors get a little bit hung up on, what if you allocate $100,000 of profit to me, which means I'm taxed, I'm making numbers up, but which means my tax obligation on $100,000 of profit is $40,000 of tax. Let's just say you live in California or whatever, it's $40,000. And you only make a $40,000 tax distribution to me. It's not fair that $40,000 reduces my preferred return, even though I haven't gotten any distribution in excess of what I've owed in taxes. I think the answer to that is taxes are an expense to an investor as part of their invested capital and return. And the idea that it's really just a matter of timing, unless investors are specifically negotiating pre-tax returns, which is almost never the case and pretty rare. It's always the economic reality that if you only get a tax distribution, that still hits the waterfall. But the idea is that in my scenario, $60,000 of profit was still kept in the business, presumably to invest in growth in the business, whether that be organic, inorganic growth, et cetera, which over time is going to have a compound effect on your returns when the company's sold down the road, right? So it's a matter of timing, right? If profits are retained in the business and they're only sending out tax distributions, that can appear to be a little frustrating to investors of, hey, you're moving down the waterfall, but I'm not actually getting a quote unquote return on capital. You are, the return is just by way of reinvested capital. If it were done a different way where it doesn't reduce the waterfall, that it just changes the timing of returns that investors aren't necessary or haven't necessarily negotiated for, and wouldn't typically be the case for a structure of this type. A little bit of a wonky answer because it's a little bit of a wonky concept. If I lost you in that explanation, that's probably okay. As you get further into your deal,
You lost me, Kev. You lost
with your
me.
advisors, you'll get deeper into what tax distributions mean, what waterfalls mean. But for those of you who are attuned to these sort of tax issues, hopefully that's making sense. I'm seeing at least one comment that says 100%
but also
agree.
just to add finer point on it, you are giving the talking point of someone who largely represents the searcher on this. It is a negotiation, right? So if you get pushback from your investors and you need those investors, guess what? That may change, and that may need to change.
My only caveat there is it is a negotiated point, but the norm is in private company investment like this is overwhelmingly how I explained it. So to to negotiate the other way is a concession by the searcher. It should be something that you're thinking through and taking into account in your return profile as you're modeling the investment, because it is not the norm that tax distributions do not reduce the preferred return or invested capital, and that heavily shifts the economics in favor of the investors that can get the return profile out of whack. That you're correct, Eric. I think it's important to walk away with that nuance. Other economic levers, just going on to the next slide here. We paused. I didn't realize we had two more over on the other side, but CEO bonus. We talked about base salary, obviously bonus, discretionary compensation. That's another economic lever that you can play around with the return profile. And then, of course, the CEO or searcher cash injection. How much is the searcher of their personal wealth and cash actually putting in the deal? Typical range 1% to 3%. There are some SBA lenders that won't lend at all if the seller's putting in zero. They want at least 10% of the 10% equity injection. That would be 10% of 10%. At least 1% of the overall project cost is what many lenders are going to require. A lot of investors increasingly are also requiring, we want the sponsor, the operator that's going to be running the business, to have some of that skin in the game. So if you think back to our example, on a $600,000 equity raise, in our example, we had 60,000 or 10% of the overall raise, meaning 1% of the, or 1.5% of the project cost coming from the searcher in this straw man example back here of 60,000 searcher equity on a total project cost of 4 million. That can be another place where you can play around with some of the economic levers and things like that, is how much personal CEO cash is going in and whether or not it is treated as preferred equity. By and large, the norm is that if the searcher's putting actual cash into the deal, they're a preferred investor, just like anyone else putting cash into the deal. But it could be a lever that you opt to pull to get the right return profile for your investors to say, hey, I'm more than happy with my $60,000 contribution, having skin in the game, but having it go to common equity so that it doesn't dilute by 10% all the other preferred investors, so they get that much quicker return on their capital, and that could impact some of your return profile. So again, different economic levers that you can pull. Anything else there, Eric?
No.
We're coming up on the hour. I think we're through the explanation of sort of typical searcher economics. What does it mean? Unpacking some of the terms, what we see as quote unquote market in the space for what that's worth. But we technically have this now reserved for another 30 minutes. We've been, I think, keeping up on questions in the chat, but happy to open up generally if people want to come up off mute or add more in the chat. Happy to just open generally the Q&A on investment terms here, unless you have any kind of final words on any of that stuff, Eric.
No, I don't. I think the only things that we didn't really touch on that matter are governance rights, puts and calls, liquidity transfers, the actual securities laws component of it. What does an offering look like? I don't know how far we want to get into the weeds. We did this just for everybody's benefit. We did this in 45 minutes last time we did it, and we were a little short on time, but this may be too much time. If you guys want to ask questions, we're happy to stay on. Otherwise, we can early.
And some of those things you just mentioned, Eric, I'll point out, are part of the guide. So for those of you that maybe joined later or things like that, I dropped a link to our guide of what to expect when raising capital that goes through similar examples, but even further detail, some of the other governance provisions, etc. It's at the top of the chat window, though. If you don't want to scroll up, no matter where you are in the chat window, if you look at the top, you'll see a pin, and I'm going to go ahead and add. It looks like it maybe added an incorrect pin.
Yeah, I think I pinned over it with the fact that this session is being recorded. So all right, if you guys want to revisit,
repinning it to the top
halfway through.
But yeah, you're welcome to download that, and that will have some additional commentary. A couple of comments coming in just now. What are the common documents investors need to see or sign as part of the transaction? Eric, you want to take that?
Yeah, happy to. So obviously the most important thing, let's just take it from the top, and we've got this in the guide. But the first is you'll put together a deck, right? Some sort of, doesn't need to be a full private placement level kind of mid-market PPM, but you will want to put together something for the investor that tells them about the deal. Your considerations when you're doing that are 10b5 securities anti-fraud considerations, that you don't want to include anything that's false, and you don't want to have any material omissions. If there's anything that a reasonable investor would want to know about the deal, you have to tell them about that information. I like to look at risk factors from publicly traded companies. If you're buying a landscaping business, certainly there's some publicly traded landscaping businesses that have risk factors that pertain to not only the large publicly traded version of the company, but also the small private version of the company that your investors would want to know about: litigation, customer concentration, things like that. So anyways, you'll put together that PPM. You want your lawyer to look at that as well, get the appropriate disclaimers in there and scrub it. From there, you want to get on the same page with your investors, and you typically do that in the form of a term sheet. So you'll draft a preliminary short form. It's almost like an LOI for investors, where you'll go out and want to get consensus. Again, harkening back to the question earlier, across all investors in the deal, get everybody on the same page with the economic terms, the step up, the preferred return, the governance rights, the liquidity, if there's going to be puts and calls, how management's going to be structured, anything that's important to the investors you want to agree to in that term sheet. That term sheet will ultimately become the governing documents, which will either be an operating agreement in the case of an LLC, or a bylaws and shareholders agreement in the case of a corporation. So you'll negotiate then that longer form version of the document, which will have all of your rights, privileges, obligations as an investor in the deal in it. From there, you'll then enter into a subscription agreement. And what I'm laying out, guys, is the typical, we call it, it's a rule 4A, but there's a bright line rule under Reg D. Most offerings are 506B or 506C offerings, which, as long as you follow the specific prescribed steps that the SEC has put in place and make the filing at the end, then you have a bright line coverage for the offering that it's exempt. So you need a subscription agreement where you're going to buy the equity, to lay out how much you're buying, who you are, a bunch of reps being made. And then that then flows into, you do have to fill out an investor questionnaire. Most folks are going to want, most buyers who are going to raise capital are going to want to do that from accredited investors, which are folks that have either sufficient income or sufficient net worth under the Reg D SEC rules. So they'll send you a questionnaire where you will fill out some information attesting to the fact that you are accredited. And then ultimately, the company that is raising the equity will make a filing with the SEC. So it's not a terribly complicated process, but it does it does elevate the risk profile of the transaction for everybody involved. I try to tell all these searchers, we try to beat it to their head that if you're doing this because you want control, because you're sick of your boss, because you don't want anybody to answer to other than obviously your customers and your wife or your husband, the moment you bring out investors, you now have those folks to think about in every decision you make and how you allocate your capital. If you want to play fast and loose with the IRS, when you own a business 100%, it's just you and the IRS. That's one thing. But when you've got investor capital involved, all of a sudden the risk profile is you have fiduciary obligations to those folks. So from a legal perspective, well, it's not complicated, I think, in structure of making these filings. There's a ton of risk involved in it for us as lawyers, for the searcher. And then we should, obviously, I think it would be irresponsible to not at some point in this presentation acknowledge the fact that there's a reason why the average self-funded searcher targets a 30% IRR in these investments, right? It's illiquid, it's high risk. These businesses are subscale. Oftentimes these operators are not experienced in the industry. So these are risky investments that you guys want to make, and you're compensated in the risk profile for that level of risk. That's the broad strokes on the kind of the regulatory and legal structure. Kevin, anything you want to add?
No, I think that's a great primer. Another question came in from our friend Rich Jordan. Just these offerings are subject to the same Reg D restrictions as commercial real estate deals. Yes, that's true. No public solicitation, accredited investors only, etc. There are nuances in Reg D depending on which exemption that you're falling under, whether or not you can take some non-accredited investors, whether or not you can do public solicitation. What I will say is in the commercial real estate space where these offerings are common, they have much larger resources paying much larger legal bills for the compliance to take money from non-accredited investors. or to publicly solicit. In the vast majority of self-funded search deals, you are not going to want to pay the legal bill associated with the scope of disclosure that would be required to go down that rabbit hole. So all that's to say is there are regulations do allow for non-accredited to some extent for public solicitation, things like that. But for all practical intents and purposes for people on this call, definitely things you should avoid to fall under what's called Rule 506B of Regulation D, where the kind of disclosure burden isn't quite as high. Someone asking if we've heard the term major shareholder friendly regarding formation documents. Is it used? Rarely, commonly. I don't even know how many hundreds or thousands of corporate formations at this point. I don't know that I've ever used that term. I'm not sure the concept. So yeah, hard for me to answer, but not a term I'm familiar with.
ChatGPT hasn't heard of it either, Kevin. So don't.
Okay, perfect. I'm almost as smart as ChatGPT. If a seller is rolling a few points of equity so that the operator or searcher can continue to use the seller's license, is it normal to include put rights in the purchase agreement? And what would that look like? I would say largely yes, though with the nuance that it's not the purchase agreement. It's usually going in your operating agreement or shareholders agreement. What would that normally look like? It's usually time-based. And what we generally tell people is the more you can get in front of and agree to up front, the easier things are on the back end. And what I mean by that is it's tempting to say, we'll have a put right after 2 years once the searcher or someone else is able to qualify for a license for fair market value of the equity. Okay, in 2 or 3 years now, you're setting yourself up for a fight of what is the fair market value of equity? Are there minority discounts for the minority position? This, that, and the other thing. If you can agree up front that it will be based on a 3.5 times multiple of EBITDA for trailing 12 months of the month ended immediately prior to the exercise of the put right, you're in a much cleaner, okay, we're exercising the put right. The document says, here's what the formula is. Here are the numbers in the formula. Are you good to go? So what does it look like? Generally, there's going to be some time-based component or action trigger component. So at any time during the 2-year period after the searcher qualifies for their own license, to give you some optionality, it could be triggered based on getting the license, could just be triggered on any time starting 3 years, etc. The only thing to keep track of there is that the SBA lenders, while there's an SBA loan outstanding, do not like changes of ownership. So that would be something you need to get in front of with your lender. And it's conceivable that they're going to say it's not allowed until the SBA loan is paid off. Not all lenders take that position, as long as it's pre-negotiated and approved up front as part of their underwriting, but some do. So just keep that in mind. Any major differences for investors when purchasing an S Corp in a stock purchase versus an asset purchase? If it's an asset purchase, no. S Corp status makes zero difference since you're not inheriting any ownership at all in the entity that has the S election. S Corp literally has zero bearing on an asset deal. On an equity deal, yeah, there are some differences, because if there's an S Corp, it's back to that prior question of the investors either have to come in their individual capacity and it can't be a separate class of equity, or what's more likely, you have to reorganize out of the S election in what's called an F reorganization, or by doing an election, depending on some facts and circumstances. There are different elections to make, but you may commonly hear as you're out there, like Googling or reading on social media, a 338H10 election. That actually applies far less often than people think it does, but there are other elections that can. So it doesn't necessarily mean anything to the investor other than it's a slightly more complicated deal, but the ultimate effect of either the election or the F reorg is, despite the transaction being an equity transaction, it's taxed as an asset transaction for tax purposes, which from an investor profile perspective can be favorable, because that's usually the favored tax treatment for a buyer and allows for some additional depreciation and things like that to limit gains that are being recognized. Should investors care about the source of investor funds? Absolutely. Number one, just on a personal basis, I'll just tell you, like, don't take money from scumbags. But
or the Saudis.
Well, yeah, exactly. But number two, any equity capital coming into the deal, the SBA is going to diligence that they have been seasoned for up to 60 days, which means all of your investors wiring their investor capital to you are going to have to provide 60 days worth of evidence of where that cash came from. If it's sitting in a bank account, that's 2 months of bank account statements. If it's your investors liquidating some holdings from their brokerage account, it's the 2 months of statements from the brokerage account and the statement showing the sale from the brokerage account and deposit into the investor's account, et cetera. So all of that to say, your investors are going to have to show and prove to the bank that they have owned or had right to those funds for 60 days and track with statements, et cetera, where those funds came from during the last 60 days. So you definitely need to concern yourself with where the money's coming from, because it's going to have to be shown to the bank, and there's no getting cute. You can't just show up with $500,000 of capital and no evidence of where it came from at the closing date. We're about to exit a licensing partner. Very glad we're, yeah. Okay, Rich is responding to my prior comment. Very glad that they were clear up front in the documents of what the valuation to buy out previous seller was. To my prior point, that will usually end up in an argument where the exiting seller is wanting more value. So the clearer you can be in the documents, the better. Final one here, Eric, I'll punt this to you. I don't even know what it says, but I just feel like I need to take a breath here. Are you seeing market norms start to form, or at least move closer to upmarket accepted terms or economics around some of those historically thorny issues like working capital pegs, purchase price adjustments, fundamental reps, et cetera? It sounds like this is more of an acquisition related question than a capital raising question, but Eric, not sure if you have any immediate reaction there. Oh, it looks like Eric may be frozen. Or I'm frozen. Does someone want to pop in the comments if they're hearing me or Eric? Okay, perfect. Thanks, guys. I guess I'll answer that. And so it sounds like we're asking largely around M&A, and the short answer there is no. With M&A terms, it is just largely driven by sophistication of the parties and sophistication of their counsel. There's no kind of evolving market of what those look, unfortunately. So we do just as many deals with sophisticated deal lawyers that know all of the things, treat a $4 million acquisition like a true M&A acquisition with kind of all the typical bells and whistles that you would have. We see plenty of $4 million deals being negotiated by cousin Johnny that's an estate planning lawyer that graduated from law school 3 years ago and doesn't know an indemnity from a representation if that were to save their life. So the M&A side of things is just still the Wild West out there in the small business arena. So one more question. A holdco structure, equity can be given at the sub level and then converted to holdco upon 100% liquidity event via predetermined formula. I'd have to understand a little bit the context of what you're asking here and why that would be implicated. In a holdco structure, you're usually either taking the equity at the holdco level where the investors are getting the benefit of everything the holdco does, or the holding company is really a personal holding company for the searcher, and the investors are coming into the platform level for the specific acquisition. And then they would only get exposure to that particular platform if it's sold or not. So if I've got Henderson Holdings and I buy an HVAC company, I may take investors into that HVAC platform. But if I then decide to transact on a landscaping platform, that may have different investors, and they're distinct and different, even though the holding company for my portion of the equity, which is the majority equity, it is maybe common between the two. The investors are going to be independent. I'm not sure I would fully understand and would have to think through probably on a more specific case, John, if this is an issue or concern, because I don't think it's very common. Would be a scenario in the latter where I've got Henderson Holdings plus investors in that HVAC platform. And in a liquidity event where that HVAC platform is sold, those investors are somehow rolling or getting equity up at the holding company. They would have their exit event at that platform. I'm not sure what the context there would be. So that may just be a little bit too nuanced of a question. And
sorry for stepping away, Kevin. I had an HVAC guy at my door and I see somebody accusing me of bow freezing. So you had to take a question. So whatever it was, it must have been a tough question. So sorry about that.
No worries.
Yeah.
It actually wasn't tough. I was just tired of talking. I think I'm at the end of the chat questions. So I think we may wrap up a few minutes early here, guys. Really appreciate the participation. I know this stuff's a little more dense than let's talk about an LOI, but appreciate you bearing with us. We'll make the recording available as soon as we can after we wrap up the webinar. We always like to edit and vet whether there's anything we need to tweak or remove that borders on legal advice or anything like that. So bear with us. It may take a couple of days or two, but we'll get a message out to everyone that attended with the recording. And of course, if anything comes up, you're looking at a deal or we can be helpful at all, don't hesitate to reach out and we can answer any questions that may be helpful to you guys.
Awesome. Thanks, everybody. Thanks, Kev.